Your grandparents did not have Robinhood. They did not have crypto wallets, AI side hustles, or passive income courses sold by 23-year-olds on Instagram. What they had was a set of money-making habits so practical, so grounded in common sense, that most of them still work right now if you are willing to use them. The problem is nobody talks about them anymore because they are too simple to sell as a product. Between 1945 and 1985, ordinary American families built more household wealth than any generation before or since. They did it without apps, without algorithms, and without a single online guru telling them to wake up at 4 a.m. They did it with tricks, old tricks. Kitchen table tricks that turned modest incomes into paid-off houses, rental properties, and retirement accounts fat enough to last 30 years. Number 14 on this list still produces millionaires every year, and number 1 costs absolutely nothing to start. Subscribe and tap the bell, because the money advice your grandparents gave for free is better than most of what the internet charges $9.97 for. If you think the old ways of making money deserve a second look, hit that subscribe button and tap the bell so you never miss a video. Drop a like if you are ready and tell us in the comments which of these tricks someone in your family actually used. Now let us count them down. Number 20. The forced savings account you cannot touch. You cannot touch. Every January, your grandmother walked into the local savings and loan and opened a Christmas Club account. She deposited $2 a week, sometimes $5, into a passbook that a teller stamped by hand. By November, she had a lump sum waiting. No credit card debt in January, no interest payments bleeding into February. The concept was almost stupidly simple. Forced savings with a deadline. By 1966, American banks held over $4 billion in Christmas Club deposits. The accounts paid little or no interest, and banks loved them for it. But the psychology was sound. Money you cannot touch is money you cannot spend. Your grandmother never heard the phrase behavioral economics, but she practiced it every Tuesday at the teller window. This trick still works. Set up a separate savings account with no debit card attached. Automate a weekly transfer of whatever you can spare. Do not name it a Christmas fund. Name it whatever you want. The point is the same. Build a wall between your spending money and your saving money, and do not give yourself a key to the gate until the calendar says so. Number 19. Buying the building you work in. Your grandfather rented a shop for his plumbing business for 8 years. Then he bought the building. Overnight, his biggest monthly expense became his biggest monthly asset. He stopped paying a landlord and started paying himself. The mortgage was the same as the rent had been, except now every payment built equity instead of building someone else's retirement. Small business owners across mid-century America did this constantly. The barber bought his barber shop. The mechanic bought his garage. The dentist bought his office building. They did not need a commercial real estate seminar to understand the math. If you are going to pay rent for 30 years, you might as well own the walls. This still works, and the math is even more obvious now. If you run any business that requires a physical space, buying that space turns a fixed cost into a growing asset. When you retire or close the business, the building is still there, still worth money, still paying you back for every mortgage check you wrote. Number 18. The side hustle before side hustles had a name. One opens PY. A factory worker in 1962 who fixed lawnmowers in his garage on weekends was not calling it a side hustle. He was calling it extra money. He charged $5 per repair, did 10 a week during mowing season, and banked $200 a month that his regular paycheck never had to cover. That money went straight into savings bonds or a down payment fund. The garage mechanic, the woman who did alterations from her kitchen, the retired postman who sharpened knives at the flea market. These were not entrepreneurs in the modern sense. They were people who noticed that a skill they already had could be traded for cash in their spare hours. The startup cost was zero because the tools were already in the basement. This trick works better today than it ever did because the internet removes the need for a classified ad or a handwritten sign on a telephone pole. If you can fix something, build something, or clean something, there is someone within 5 miles of your house who will pay you to do it this weekend. The only thing that has changed is the method of finding the customer. The principle is the same one your grandfather used. Number 17. paying extra on the mortgage every single month. Your grandparents made extra principal payments the way some people go to church, religiously, without question, and with a faith that the math would reward them. A family earning $8,000 a year in 1960 who added just $25 a month to their mortgage payment shaved 8 years off a 30-year loan and saved thousands in interest. Wall Street spent the next 50 years telling Americans that mortgage debt was good debt, that the interest deduction made it smart to carry a balance, that you should invest the difference instead of paying down the loan. The math sometimes supported that argument, but it assumed people would actually invest the difference. Most did not. They spent it. This trick works right now. Run the numbers on your own mortgage. An extra $100 a month on a $300,000 loan at 6% saves you over $60,000 in interest and cuts years off the payoff date. Your grandparents understood that a paid-off house was freedom. Freedom from the bank, freedom from the fear of layoffs, freedom to retire on their own terms. No spreadsheet captures what that feels like, but your bank statement will. Number 16. Buying savings bonds through payroll deduction. Your father bought Series E savings bonds through automatic payroll deduction. 50 cents a week came straight out of his paycheck before he ever saw it. By 1945, 85 million Americans owned savings bonds, the broadest ownership of government debt in history. The bonds earned modest interest, but the real value was invisible. Money deducted before payday could not be spent. Families stacked bond certificates in fireproof boxes and sock drawers, forgetting about them until a child needed college money or a roof needed replacing. That quiet accumulation, $10 here, $20 there, compounded into meaningful wealth over decades. The modern version of this trick is automatic investing. Set up a recurring buy into an index fund or a high-yield savings account timed to your payday. The money leaves before you see it, before you can spend it, before you can convince yourself that this month is different. Your father's savings bonds have been replaced by better vehicles, but the engine underneath is identical. Pay yourself first and make it automatic so discipline is not required. Number 15. Living on one income and banking the other. Married couples in the 1950s and 1960s who both worked often lived entirely on the lower salary and saved the higher one. A husband earning $5,000 and a wife earning $3,000 in 1960 could live on the $3,000, bank the $5,000, and accumulate a down payment for a rental property in 2 years. The lifestyle was modest. The math was ferocious. This worked because they refused to expand their spending to match their combined income. 1 car instead of 2. A smaller apartment for a few more years. Meals at home 6 nights a week. The sacrifice was temporary. The savings were permanent. 2-income households today can do exactly the same thing. If both partners earn, pick the smaller paycheck and build your entire budget around it. Direct deposit the larger one into a savings or investment account. Most couples cannot imagine living on one income because they have already committed both. The trick is making the decision before the lifestyle inflates. Your grandparents did not call it lifestyle creep. They called it living beyond your means, and they refused to do it. Number 14. Opening a small franchise. The franchise boom of the 1950s and 1960s created more self-made millionaires than any stock exchange. A McDonald's franchise in 1960 cost about $75,000 to open. By 1975, that single location could generate $200,000 a year in revenue. The model handed ordinary families a proven system and told them to follow the manual. No invention required. Veterans used GI Bill loans. Teachers pooled savings with siblings. Mechanics mortgaged their homes. The startup capital was real and the risk was genuine, but the playbook had been tested and the failure rate was lower than independent businesses. Entire family dynasties across the Sun Belt traced their wealth back to a single franchise location opened with borrowed money and 12-hour days. Franchise ownership still works, and the range of entry points is wider than ever. A cleaning franchise, a tutoring center, a mobile repair service. The initial investments start well below 6 figures for many brands. The principle has not changed since Ray Kroc wrote the playbook. Find a system that works, follow it exactly, and put in the hours that most people will not. Number 13. joining a credit union instead of a bank. Before mega banks swallowed the industry, credit unions served neighborhoods like family. They paid higher interest on deposits and charged lower interest on loans because they had no shareholders demanding profit. A teacher's credit union in Milwaukee might offer a car loan at 4%, while the bank down the street charged 8%. That spread compounded across every major purchase over a lifetime. By 1970, over 23,000 credit unions operated in America. They financed first homes, small businesses, and used cars for families the big banks would not touch. The community institution anchored middle-class wealth in ways that a Chase or a Bank of America branch never tried to. Credit unions still exist and still offer better rates than most commercial banks. The average credit union savings rate is higher and the average loan rate is lower. The deregulation wave of the 1980s weakened some of their advantages, but the core structure has not changed. If you are still banking at a for-profit institution and have never compared rates at your local credit union, you are leaving your grandparents' easiest trick on the table. Number 12. Buying a duplex and living in half. Before 1980, a working man could buy a duplex in Cleveland with 10% down and a handshake from a banker who knew his name. FHA loans insured mortgages so banks would lend to ordinary people. A duplex that cost $18,000 in 1962 could generate $150 a month in rent from the other unit, enough to cover the entire mortgage. You lived in one half. Your tenant paid for the building. Families did this twice, 3 times, building small portfolios of rental homes that threw off cash every month. No property management software, no spreadsheets, just a ledger book and a handyman who owed you a favor. By the time those duplexes were paid off, they were worth 6 or 7 times the original price. House hacking, as the internet now calls it, is the same strategy with a new label. FHA loans still allow low down payments on multi-unit properties up to 4 units. You can still live in one unit and rent the others. The numbers have changed. The principle has not. Your grandparents figured this out 60 years before a podcast named it. Number 11. Buying and holding blue-chip stocks forever. Your grandfather called his broker, a man he knew from church or Rotary Club, and bought 20 shares of ATAN-DT. He held them for 30 years and reinvested every dividend. He never checked a ticker. He never panicked during a correction because he did not know it was happening until he read the newspaper 3 days later. That ignorance was an asset. Between 1950 and 1980, the Dow Jones rose from 200 to 838, a 4-fold increase before counting dividends. Investors who bought blue chips and held them through every recession, every war, and every political crisis built enormous wealth through sheer inaction. The broker charged commissions that would horrify modern investors, but he also kept clients from selling in a panic, which was worth more than any algorithm. This trick has gotten cheaper and easier. Index funds let you own every blue chip at once for almost no fee. The hard part is the same as it was in 1955, buying, holding, and refusing to sell when the market drops 20% and every headline says the world is ending. Your grandfather did not have a trading app, which meant he could not make the mistake of selling at the bottom. You have the app. The trick is pretending you do not. Number 10. Buying used and investing the difference. Your grandparents bought a 3-year-old Buick instead of a new one and put the $800 they saved into a savings account. They bought the floor model refrigerator and banked the discount. They wore last year's coat and deposited the difference. The strategy was not deprivation, it was redirection. Every dollar that did not go to depreciation went to appreciation. A family that saved $1,500 a year by buying used instead of new and invested that money at modest returns could accumulate $50,000 in 20 years. That was a college education, a down payment, or a decade of supplemental retirement income. The purchases they skipped were forgotten within months. The savings they built lasted a lifetime. This works better today because the used market is massive and transparent. A 2-year-old car with 20,000 miles costs 30% less than the same model new. A refurbished laptop works the same as a new one for half the price. The trick is the second half of the sentence. Buying used only builds wealth if you actually invest the savings. Otherwise, you are just being cheap. Your grandparents were never cheap. they were strategic. Number 9. Maxing out the company match from day one. When 401k plans appeared in 1978, the early adopters who maxed out employer matches stumbled into one of the greatest wealth-building opportunities ever offered to working Americans. A company matching 50 cents on every dollar up to 6% of salary was handing employees a guaranteed 50% return before the market did anything at all. Workers who started contributing in the early 1980s rode the greatest bull market in history. A $2,000 annual contribution with a company match invested in an S&P 500 index fund starting in 1982 would be worth over $1.2 million by 2020. The employees who maxed their match from day one retired comfortably. The ones who said they would start next year usually never did. The match is still free money sitting on the table at most companies. If your employer matches any percentage of your retirement contribution, and you are not taking the full match, you are declining a raise. That is what your grandparents would call it, a raise you are too lazy to pick up. Start this week. The difference between starting now and starting next year is the difference between retiring at 62 and working until 70. Number 8. Growing your own food. A vegetable garden in 1955 was not a hobby. It was a line item in the family budget. A quarter-acre plot behind the house produced tomatoes, beans, peppers, squash, and corn that would have cost $400 a year at the grocery store. Your grandmother canned the surplus in August, and the family ate from those jars through February. The savings went straight into the Christmas club or the mortgage payment. Victory Gardens during World War II produced 40% of the nation's vegetables. The habit carried over into peacetime. Families who kept gardening after the war had a permanent reduction in their grocery bill that freed up cash for saving and investing every single year. A backyard garden in 2026 can still save a family $600 or more per year in produce costs, and the startup expense is less than $50 for seeds and soil. The math is small on a weekly basis, but it compounds across a decade. More importantly, the habit of producing something instead of only consuming things changes how you think about money. Your grandmother understood that. She did not buy tomatoes. She grew wealth one plant at a time. Number 7. The envelope budget system. Your grandmother labeled envelopes. Rent, groceries, electric, church, savings. On payday, she divided the cash into the envelopes, and when an envelope was empty, spending in that category stopped. There was no overdraft fee because there was no overdraft. There was no impulse purchase because the grocery envelope did not care that shoes were on sale. The envelope system was zero-based budgeting 50 years before anyone gave it that name. Every dollar had a job before it arrived. The system was physical, which meant it was visible, which meant it worked. Swiping a card feels like nothing. Watching the grocery envelope get thin by Wednesday feels like a warning. Cash envelopes still work, and digital versions of the same idea exist in every budgeting app on the market. The principle is identical. Assign every dollar a purpose before you spend it. The people who do this consistently save 20 to 30% more than people who budget loosely or not at all. Your grandmother did not need an app. She needed 7 envelopes and the discipline to respect what they meant. Number 6. Selling door to door or at the kitchen table. The Tupperware party. The Avon lady. The Fuller brush man. Your grandparents' generation turned living rooms into showrooms and made real money doing it. An Avon representative in 1965 who worked her neighborhood 3 evenings a week could earn $200 a month in commissions. That was meaningful income in an era when the average mortgage payment was $90. The model worked because it ran on trust. The Avon lady was your neighbor. You bought from her because you knew her, and she kept your business because she showed up with the right shade of lipstick every month. The transaction cost was zero because the relationship already existed. Direct selling still generates over $40 billion a year in the United States. The products and platforms have changed, but the core mechanic has not. If you have a network of people who trust you and a product worth recommending, you can sell it without a storefront, without a website, and without an advertising budget. The kitchen table is still open for business. Number 5. Repairing instead of replacing. Your grandfather resoled his shoes. Your grandmother patched jeans until the patches needed patches. The television repairman came to the house and fixed the set for $12 instead of the family spending $200 on a new one. The default response to a broken object was fix it, not replace it, and the savings over a lifetime were enormous. A family that spent $500 a year on repairs instead of $2,000 on replacements saved $1,500 annually. Over 30 years, invested at modest returns, that habit alone could produce $80,000 in wealth. The repair mindset was not about poverty. It was about refusing to throw money at problems that a screwdriver could solve. Repair culture is coming back. Right-to-repair laws are expanding. YouTube has a tutorial for fixing almost anything you own. The trick is the same as it always was. Before you buy a new one, ask whether the old one can be saved. Every item you repair instead of replace puts the cost difference back into your pocket, and your pocket is where wealth begins. Number 4. Networking at the lodge, the church, or the club. Rotary lunches, Elks Lodge meetings, Masonic dinners, church potlucks. Your grandparents called it community. It was also the most effective business development strategy of the 20th century. A car dealer who met a bank manager at Rotary got a loan approved the following week. A plumber who met a builder at the lodge landed a contract that kept his shop running for 5 years. By 1960, nearly 1 in 3 adult American men belonged to a fraternal organization. Business was done on handshakes after meetings. Members helped each other find jobs, financed each other's startups, and referred customers to each other's businesses. The trust built over years of shared meals was social capital that converted directly into financial capital. This trick works today and it costs almost nothing. Join a local business association, a chamber of commerce, a church group, a volunteer board. Show up consistently. Help people before you ask for anything. The relationships you build in person will produce more business than any social media strategy because a handshake carries more weight than a follow. Your grandparents knew that. LinkedIn still has not figured it out. Number 3. Negotiating everything every time. Your grandfather negotiated the price of a car, the rate on a mortgage, the cost of a refrigerator, and the fee for getting his driveway paved. He did not accept the first number anyone gave him because he understood that the first number was designed to leave room for the second one. The sticker price was an opening offer, not a fact. Families who negotiated consistently saved thousands of dollars a year on purchases that most people paid full price for. A 2% reduction on a mortgage rate saved more over 30 years than most people earned from their best stock pick. A $500 discount on a used car was a week's wages recovered in 15 minutes of conversation. Negotiation still works on almost every major purchase and many minor ones. Medical bills, insurance premiums, cable packages, rent renewals, contractor quotes. The person on the other side of the table expects you to ask for a better price. When you do not ask, you are volunteering to pay a premium for politeness. Your grandparents were polite. They were also relentless. Those two things are not in conflict. Number 2, living below your means as a point of pride. The wealthiest families on the block often drove the oldest cars, wore the plainest clothes, and never mentioned money at the dinner table. Frugality was not embarrassment, it was strategy. A family that earned $7,000 and spent $5,500 had $1,500 a year to invest. Over 20 years at modest returns, that surplus alone could build a nest egg worth $50,000 or more. Consumer culture had not yet perfected the art of making people feel poor despite earning good wages. Keeping up with the Joneses existed, but the Joneses themselves were often quietly broke. The families who built real wealth were the ones who let the Joneses win the appearance contest and kept the cash. This trick requires something the internet actively destroys: the ability to feel satisfied with enough. Social media shows you what everyone else is buying and makes your perfectly good life feel inadequate. Your grandparents did not have that problem. They compared themselves to their savings balance, not their neighbor's driveway. The gap between income and spending is where all wealth begins. Widen that gap and everything else on this list becomes possible. Number 1, talking about money at the kitchen table. The single most powerful cash-making trick your grandparents used cost nothing, required no account, and could not be taxed. They talked about money with their children, a father who showed his son the rental property ledger, a mother who explained compound interest using the Christmas Club passbook, an uncle who brought his nephew to the shop and taught him a trade. These were not financial education programs. They were Tuesday evenings and Saturday mornings. The knowledge transferred across those kitchen tables built more lasting wealth than any course, seminar, or app, because it came wrapped in trust and reinforced by example. A child who watched her mother divide cash into envelopes grew up budgeting without thinking about it. A boy who tagged along to the hardware store with his father learned to price materials before he learned to drive. When families stopped talking about money, stopped showing the next generation how the machinery of wealth actually worked, the chain broke. No algorithm has figured out how to replace that conversation. The good news is you can restart it tonight. Sit down with someone you love and explain one thing about how your money works. That single conversation is worth more than every finance book on Amazon combined, because the person hearing it trusts the person saying it. That is the trick. That has always been the trick. 20 tricks, most of them free, all of them tested across decades by people who had less information, less technology, and less income than you have right now. They built wealth anyway because they understood something the modern economy tries very hard to make you forget. The basics work. They have always worked. They will keep working long after the latest app shuts down and the newest guru moves on to selling something else. So tell us in the comments, which of these tricks did your grandparents use? Which one are you starting this week? And which old school money move did we miss that deserves a spot on this list? Drop it below. We read every single one. If this countdown changed how you think about money, hit that like button and subscribe so you never miss a video. Tap the bell for notifications. Share this one with someone who needs a reminder that the old tricks still work, because they do. We will see you in the next one.